Hey, alright, well, first video on here. Let's make it count. Starting a little stock lecture class at my school. It's going to be 12 classes, half hour each, 2 a week, Mondays, or not, Tuesdays and Wednesdays. I'm going to put them up on here. I think it'd be fun. I don't think a lot of schools teach about finance and retirement. So, I'm trying to put it out there. I think it's important. I hope you guys like it. First six, it's split up, so 6 classes are about stocks, and then the other 6 are about technical analysis. The technical analysis classes are going to be pretty much applicable to any real asset class. And yeah, here we go, guys. Whoever wants to walk in after that, that's cool, whatever. Alright, thanks. Have a good one. Alright.
Wait, let me start.
Oh, I just started it. Alright, guys, I gotta commend you guys on being here today, because just by being here, you guys are making like a big step towards your financial future, because that's like the one thing school doesn't teach you, and it's really important. So we're gonna talk about the stock market. So before we talk about that, you guys gotta understand like what builds wealth, right? So if you go out and you buy something, you can buy an asset. That's the best word ever, guys. It just sounds great. You can buy an asset or a liability, okay? When you buy a liability, it's something that takes money out of your bank account every time, right? So you buy a house, you have to pay bills for it, you have to pay your rent, you have to pay for water breaks. It's a liability. It takes money out of your pocket. You buy a house and you rent it out to somebody, it's an asset. As long as the money you take in covers your expenses, then you're making money from buying something, it's paying you back. That's what an asset is. That's what you want, and that's how you build wealth. So 3 main types of assets are going to be real estate, paper assets, and then kind of side hobbies. And we're going to talk about paper assets mostly for this. Real estate is like buying houses, selling houses, renovating houses. That's a big different thing. Paper assets can be CDs, bonds, or stocks. Those are what we're going to be about, guys. So CDs are the least risky of the 3, and those are government, 100%. The government's going to guarantee your return. So if you have a CD, the government will say, how long do you want to put your money into this CD? And depending on how long you can put it in, you can like put it in for a couple months to a couple years, maybe 10 years. They'll pay you somewhere from around 1% to 1.5% usually. And what that means is you put in $100, you'll get $100 and an extra $1, $1.50 back in interest, that's a CD. It's a guaranteed. It's 100% guaranteed by the government. And the thing about that is inflation is 2% a year. So every year your money sits in your bank account, and you usually get paid like 0.01% or something on it. You're losing 2% of your purchasing power every single year because the federal government prints away 2% of the US dollar's purchasing power, which basically means every single year the same dollar is worth 2% less. So by not having your money in assets making you money, your money is just sitting there and it's losing purchasing power every year. So that's what CDs. Bonds are kind of medium risk. For us, bonds and CDs, I mean, we're young kids. It's not really what you guys want to be focusing on. Bonds are about 3 to 4% annual returns, and those are more than inflation, and those are going to make you money, but bonds are more for risk diversification. If you're older and you have a lot more money, you might buy more bonds. Bonds are basically, you'll say to a company, I'm going to give you this much money, and they'll pay it back to you over a course of, they'll pick a course, might be a year, might be 1 to 3 years, and they'll pay it back to you. The money you give them, they will pay it back over a course of whatever it is, and then they'll give you the interest on top of that. And at the end, you make about 3 to 4% per year with bonds. Bonds are less risky than stocks because the only way you're going to lose money with a bond is if the business or the corporation stops paying it to you. And the only way they're going to stop paying it is if they literally go out of business. So as long as you pick reputable businesses, usually bonds are kind of medium risk, you get medium returns. But the stock market is going to be our best asset, guys. Stocks are the average return for the entire stock market for the past 80 years, like 7% a year. And 7% is a big number, and it's a good number for an asset return rate. Real estate's about 10%. That's a lot more worth, it's a lot more active. So stocks, about 7% a year. So when you buy stock in a company, what you're basically doing is whatever the company is, they decided to become an incorporated company or a corporation. And they do this because they want tax benefits. So what'll happen is the company will take in money, and if it was like a normal business or an individual thing, they would have to pay a self-employment tax on whatever money they make. But when they incorporate, they let the entire business be owned by the shareholders of the company. So everyone who owns the stock is a shareholder, and they own part of the company. And this lets them get by with a lot of tax laws. So they can take the money in and then spend it on whatever the heck they want, as long as it's related to the business. So if they need a business Lamborghini or they go on a business vacation, they're going to be able to buy that with the money from their business bank accounts before they pay taxes on it. So if by the end of the year they spend all their money paying employees for like real things and other business expenses, buildings, they're going to have a lot less money at the end of the year in that account, and that's what they'll pay tax on. So that's why people start businesses and incorporations, and that's where stock comes from. It's traded on exchanges. We'll talk about exchanges later, but that's basically what a stock is. So 7%, the average return for the past 80 years in the S&P 500, which is just we're gonna talk about it later. It's an index fund, but it's just what the average market return is 7%, and 7% is a big number. So we take 7%. Now, average U.S. household income is $50,000 a year. So if we can take 20% of that and save it every year, the real strategy to doing that is to just save before you spend. So if you get a paycheck, 20% of that retirement fund, you put it straight in there. You don't let anything mess with that. You just go right to it. You put it in. You took 10 grand a year every single year. If you just completely ignore raises or whatever, just the average U.S. household income is 50 grand, 20% of that. And if you start with that, you start a retirement fund. I mean, you guys probably get out of high school at 18. 18. The retirement age is like 66. So if you start working at 18, retire at 66. That's like 48 years. Yeah, 48 years. With a 7% return, if you just continually invest that into the stock market and get the average return for the next 48 years at 7%, you guys are retiring a millionaire. That's $4 million, guys. Being a millionaire is not difficult. It just takes like consistent dedication, and you just do the same thing over and over. And when you keep buying assets over and over, the interest on those assets earns you more money with the money you put in. It's called compounding, and it's great. I mean, this graph shows it. 48 times 10,000, you're putting in 480,000 in straight cash, but your cash is earning you money and earning you more interest, which then earns you more money on top of that. And that's how compound interest works. So if you just do that and you started working straight out of high school, you're going to retire with a $4 million retirement plan off of the average return for the stock market. And that's after inflation is 7%. And that's why the stock market is just so important, because you can just get, this is just an average return, but if you keep putting money into it and you put it in early, you're going to get the big returns over the long run by continuing to stick with it and keep it going. But the important part for you guys is starting early, okay? So if we do this and we slack off and we start 4 years later, so we'll have 42 years of growth and we still retire at 66. Our $4 million turns into $2.6 million. I mean, that's a big difference. So just a little bit of extra time at the end is gonna make the biggest difference. Like, you're gonna make from 42 to 43 years, like almost $200,000 just off of interest and putting in 10 grand. So by starting early, starting young with investing in assets, your future is gonna be a lot better when you get your retirement. A good way to think about this, if we go out and we're thinking, I got this paycheck from my job and I got $1,000. I'm gonna go buy a $200 pair of shoes. I think the better way to look at it is, what would that $200 be if you put it in the stock market for 35 years? That $200 pair of shoes has an opportunity cost of $2,200 if you invest it with your retirement fund. So what you can do is you can save money when you're younger, put it in investments, and it's going to be worth a lot more later. So you can, you can buy 10 pairs of $200 shoes with that, almost 11. That's the important part of why starting early matters. And yeah. All right, let's talk more about stocks. So stocks specifically are going to be our number one asset class. Now, we like stocks because, here, let's pull this up. So the average stock market is calculated, the average return for the stock market is calculated by the S&P 500 index. It's basically the conservative average, what people base all their stuff off of. And the S&P 500 index, we're going to talk about index funds later, but it's just a basket of a wide variety of stocks, not too tough to conjure up. Stocks are just part of companies. So can anyone in here name any company in existence? Amazon, thank you. Amazon stock. If I'm an investor, because you guys are investors now, Amazon's expensive. I don't like Amazon, but it's okay. We'll use it as an example. What this chart is showing is just how much it costs over time. And you can see as time increases, as time changes, the price of the asset changes. Because over time in the stock market, your money is going to grow based off how long it's been in it. So this is like the yearly chart for Amazon. This is just a stock, but you're buying part of the company, and the value of your portion of the company increases based off of what other people are willing to pay for it in the market. All right. That's pretty good. We did pretty good. Good job, team. That's basically the stock market. Any questions? Wow, cool. That means we get to talk about more specific stuff. Let's see, what should we talk about? When you buy stocks, you're going to go through brokerages to get them, and you'll go through exchanges. We're going to talk about those later. The important thing to know about those is you're going through the SEC, and the SEC is the Security Exchange Commission. They regulate basically the whole stock market, and they're important because all the rules of trading are set by the SEC. And you need to remember when you're investing the rules. So if you're starting out, there's something called Pdt Rule. There's a lot of dumb rules, and you need to follow them. So you can't trade like three positions in a day, open to close, if your account's less than 25 grand. It's a dumb rule, but the SEC says that's the rules, so you have to listen to SEC. The SEC is basically just the big regulating authority for the stock market. And they're going to also regulate rules on 401ks with the IRS. And 401k, they're just like retirement accounts, right? So you can access them when you turn retirement age, which is like 66. And retirement accounts are just like normal brokerage accounts, but what you can do is you can put money in pre-tax, and you'll be in your working years of your life when you put this money in, so your tax rate's going to be higher. And you put your money in the account, the maximum annual addition right now is about 18 grand. It's going to increase to 18.5 next year. And what that's going to let you do is put the money in without paying taxes on it. You're going to let your money grow, and eventually when you retire, you're going to pay taxes then when you have a lower tax rate instead of paying it earlier, which means you'll have more initial money to put in, and then at the end you pay your taxes on it. This is basically how people retire, guys. All they really do is follow a simple little formula. They just keep putting money in the market. With the 7%, that's an average. So like you guys know the 2001 bubble, 2008 crash, the 19-something, bad markets. It's just an average return of 7% through all of that. So you just keep it, like every time you get a paycheck, you just put it in no matter what. And you'll get that average return. And that's how people set up retirement funds. It's really not that tough. Everyone here can retire a millionaire. I promise. You just gotta follow the rules. Just gotta keep it simple. What's up, Jake?
So that 7% you're getting back a year, is it reinvesting it for you or what?
Yeah.
Or is it you up to decide what you want to put it in when you get the 7% back?
So you can just put it in like the dumbest little funds. Here's the S&P. This chart goes from 1950 to 2018. That's 2018, 88 years. Wait. No, 78 years. No, 68 years.
Make that math.
It's 68 years. It does matter. I don't want to. All right, 68 years. And then the percent gain is 14,180. So 14,180. And then you're gonna do times 0.98 to the power of 68 years, because inflation's 2% a year, so the purchasing power of that dollar is gonna go down 2% every single year. And you're gonna divide by 68 years. And that's what you're getting. That's the average market performance. This is like the conservative average market performance. And that's gonna give you your average market return if you just put it in the safest funds, power 68. What did I do wrong?
7%. He's not saying like that's wrong. So like you put it into a stock and then you make 7%.
You're diversifying that money, right? You're talking about that.
Yeah, this is the whole market.
Yeah.
It's completely diversified.
It's just an average for each, or for the average stock performance each year post-tax. Because average performance of stock market is like 9 to 10%, but after inflation it's going to be closer to 7%.
Yeah, I don't know what I did wrong. I did something wrong. But, you know what? Google doesn't do things wrong. That's a little bit. That's before tax, before inflation. I mean, I try to keep my estimates conservative. 7% is a little more conservative. Any other questions? Honestly, it's just open discussion. We got like 15 minutes left in here. That was all I really had to go through.
So you're talking about 3-4% on bonds. That's just government issued, right? Not speculative bonds.
No, that's corporate bonds.
So some that you
Like Wells Fargo, Google, big projects. They need money. I mean, they do bonds because they need money to build something, and then they'll take the money you give them and build it, and then they'll pay you back as the building or whatever they do with it starts to make them money, and that's how they get the money to pay you back. It's like they just want to finance something, get it going. Bonds are good for diversifying when you have like $4 million in your bank account. But I mean, you guys are young. You guys can take the risk of the market. The market's riskier, but over the long term, it's 7%, even with the crashes.
That's assuming you invest in big corporations, though, right? Like
No.
big companies or.
as long as a company is stable.
Well, you can invest. We're gonna talk about index funds. It's as long as you diversify your portfolio, the average return is not the toughest thing to get. I mean, you're just following index funds. You can just invest in index funds and get your average return. Or if you invest in individual stocks, which is what Wednesday classes are about, you can beat the return. I mean, if you actively manage, and get 10% a year, that is not, is an average, 10% average a year, with the same figures as before, putting in 20% of the U.S. average household income. And you can get 10% for 46 years, 48. I mean, you're turning $4 million. I mean, it's probably somewhere around, 11.5 million. I mean, the higher percent you get, it's just the more money you're gonna get from that.
That's assuming you work full time during college, yeah, right? You said you started
Yeah,
at
well,
18.
college is different.
Most people.
I mean, this is if you just go to work right out of high school.
Yeah.
If you go to school,
Yeah. So you get a 4
you're gonna, and you get a 4-year degree, and you make what, like 70 pre-tax?
Yeah.
I mean, and that's what, like 4 years off of this, 42, and then would change, or 44, then 7. I mean, 20% of 70, 13, 14. You're gonna be putting more money away. You're still gonna make, at the end, your retirement fund's still gonna be the same, but you're gonna have more money every year to live on, more money to spend, better quality of life. But I mean, it's the same. And if you go to like law school or if you become a doctor and make like $100 grand a year, 20% of that's 20, and what med school's like 8 years. So this is 40. I mean, you're still turning out very, very close. I mean, the stock market's a great equalizer. We just looked at 3 different lifestyles: straight out of high school working, straight out of 4 years of college working, and being a doctor. And these guys all have the same. I mean, a doctor, the average of 100,000 a year, and out of college, the average is 70 a year. Those are estimates, but every single person here has the same retirement fund, because the people who start earlier make more interest on their money quicker, and the people who start later make more interest. They make the same amount of interest for less time, but on more money later in life. So you can increase your retirement fund by increasing principal addition, increasing time, or increasing the rates. And the rates I like to keep the same. The biggest thing you cannot ever get back is time. And that's why it's important to start earlier, rather than worry about how much you're starting with. What's up?
You're talking about what, 20% a year you're putting into it?
Yeah, 20% of your
average,
salary.
or is that, what do you think about 20%?
I mean, I prefer to invest more. I've worked, jobs, and I've done day trading and stuff like that. And when I worked like a minimum wage job, I put 80% of my paycheck straight into investments.
What about
Because
like once you get a real like
once you
Once you have to pay for a lot more things, what would
the strategy really is to just take out. You got to set yourself a number in your head, right? I think 40%, if you can handle it. I don't mind lowering, like,
As long as you give
how
yourself
good
a
your living
livable
is.
amount of
Yeah.
cash. Like Elon Musk lived in an office space.
I
that
mean,
costed like $200 a month, so that he
if
could
you can
put
save
money into his office.
more money, you can invest more money. And the best way to do it is to just think in your head, what kind of quality of life do you want? You can have like a little bit of a not less fulfilling, but a little more low key life, and put more money in, and just say at the beginning of the month, X much money comes out of my paycheck and goes straight to this, and I don't touch it, and I have to budget for the rest of it. I guess the one exception of that's debt. Just try to avoid debt, guys. I mean, you guys are probably smart with credit cards. Cars, though, like, I would not lease a car. Like, just buy a car in full cash. The only thing I think is good to take debt on is houses, and then there is forms of good debt you can do with real estate investments, where you can have debt at 4% and a return of 10% a year and pay off the debt and your expenses and keep that as an asset. But debt on like cars and credit cards, just avoid it at all costs, because you have to pay that before you invest, because you don't want your debt growing at the same rate as what your investments are doing, because usually that's going to be a much higher rate than the stock market, 7%. So
Most companies will match, I'm pretty sure. So
yeah,
if
if you
like
for
6% or
401ks,
something.
yeah, they'll match.
Yeah.
So that really helps if you can get the benefits of that. I mean, that's huge.
If you're putting 20%, they'll put 6%.
But the important thing for that, and that's a retirement account, that's a 401k, is you straight up can't touch that until you're 66. And for some people, that's good. I mean, you leave this in there until you're like, I mean, that can be really good. You guys can retire wealthy. You just don't touch any of it. I take out some of what I put in and try to put that in different assets that aren't the stock market, because I think diversification is key. The best thing you can do though is to just keep putting your money in assets, because the more assets you buy, guys, the tougher it's going to be to not be rich. I mean, if you're buying a lot of liabilities, being poor is really easy. If you only buy like, you know, like if you just go out and spend like $5,000 on a flat screen TV versus just going out and putting $5,000 in the S&P 500, it's a huge difference. This money just completely disappears, and that's what people say, you know, out there, like, oh, the stock market, you're gonna lose your money. Like, what's the difference? There's inherent risk with putting $5,000 in the market, but your alternative is putting $5,000 in something that's like gonna be worth nothing. And by losing $5,000 in the market, you're gonna learn a lot more than just buying $5,000 flat screen TV. All right.
Basically, what he's saying is that the largest portion of our country's wealth is based off of speculation in the form of assets. The top 1% in our country has half of our country's wealth, and that was a number in like 1980, so that's probably closer to 65% of our country's wealth by now.
I thought 99.
That was $5 trillion at that time, probably closer to $8 trillion now. And 2/3 of that top 1% is based off of stock and real estate speculation.
Oh my god, I saw this video on CNBC yesterday, and I guess I'm just not going to be able to find it. Oh yeah, it's like a 3-minute video. This is Warren Buffett. I mean, you guys probably haven't heard of him. He shorted the housing market in 2008. He's basically like one of the richest people on earth. I think this is a great video that kind of sums up everything I just said. It's called WarThunder.com. I would highly recommend it. It's a great game. It's got tanks, it's got guns. What else would you want?
So I want to ask a little bit about some of the new investing things going on in the markets. And Greg Wonder from Bakersfield wonders about target date funds. And I want to also ask about all the new index funds with the brain. Are those things really adding value?
No, not really. The S&P 500 is the one that's what I use, and that I made for 10 years is the one I told the trustees of my wife to put 90% of the fund money in paper. The S&P 500 is, I don't know whether it's 80% of the market value of, of everything you can buy in this country, and it's over, I think it's over 20 trillion, and you're buying America. And let me give you a figure that'll blow your mind, I think. I bought my first stock when I was 11 years old. It was the first quarter of 1942, shortly after Pearl Harbor. I spent $114.75. Three shares, $114.75. If I put that 114 into the S&P 500 at that time, and we invested the dividends, think of a figure to what it would be worth today.
Oh man.
Well, it's, but I just want your audience to think for a second.
Okay.
The answer is about $400,000. So if I, as a little kid, had taken that $114, I'd say the shovel and snow or whatever I'd done, $400,000 today, one person's lifetime. That's America. That isn't me. It is the huge tailwind the American economy gives to any equity investor. Now, the market's going down many times during that time. People have panicked during that time. Headlines have been terrible. It looked like we were losing the war when we first won. But America is a powerful economic machine that since 1776 has worked. It's going to keep working. Now, you don't want to buy to hold for a year. You don't want to buy with the idea that you could sell it in 2 years or 3 years necessarily to make money. You could lose money that way. But if you buy it for 10, 20, just keep buying the S&P 500 index and forget about all the other nonsense that's being sold to you, because I'll guarantee you one thing about the stuff being sold to you, it will carry bigger fees than what I'm talking about.
Yes.
Yeah.
And there's no reason to think that you're not, you don't know if it's 400,000, but that same sort of process or returns won't happen starting right now.
The S&P 500 companies have earned well over 10% on equity, often 15% annually for years and years and years and years. They've done it with Democratic administrations, with Republican administrations. Now, you get money compounding at that kind of rate underlying your investment, and you get a diversified group of that. I mean, you're going to do well.
What a guy. Yeah, guys. Well, that's basically it for the introduction. Point being, money today can be worth a lot more tomorrow in investments. Hope it helped. Wednesdays are going to be more about technical analysis and looking at how to trade stocks and looking at how to beat the returns of the market. It's going to be fun. Hope to see you guys there.